Hey everybody, welcome back to the Wealthy Idiot Show. My name is AJ, and today we have on Ryan Crypto again. Hey Ryan, how's it going?
How's it going? How are you doing, sir?
Oh, I'm doing pretty well, thank you. So you flipped the script on me a little bit. It sounds like I got you interested in at least looking into real estate, which I think is pretty cool. And so you wanted to come on and actually ask questions and maybe, do the interview the opposite direction this time.
Yeah, so a very quick background with me. I made horrible financial decisions when I was younger. I had student loan debt. I started learning about investing. Crypto was one of the things I learned about besides 401k, and I got really obsessed with crypto. I just found it fascinating, and I made some fortunately good decisions there, and I did pretty well in that space. But real estate, to me, the more and more I learn about it, it seems like probably one of the best, if not the best, investments that I think somebody can make. And I'm not just saying this because of the show. I really, truly believe that from the more I understand about it. So I'd love to get into the real estate game as modest as I can. I'm very new to it. I've read a little bit here and there over the years. So you've got me very interested, and I'm looking at purchasing a property very soon within this next year sometime. So yeah, that's where I'm at.
All right, sounds good. So go ahead and kick it off anytime you're ready.
Okay, so when someone's buying their first investment property, I'm wondering, what is your top criteria? Is it location? Is it price? Is it the cash flow potential? What are some of the check boxes that you look for?
Yeah, the answer to that is yes to all the above. So I play the long game. So you've heard of like flippers and stuff. They're going to buy houses, renovate them, and then immediately sell them off. That's a different consideration. I'm looking at 20 to 30 years, potential. So the main criteria would be I want to buy in a place that I know is going to be improving over the next 20 or 30 years, or at least I suppose it will be improving, right? So some key indicators is like, are companies moving there? Are the laws and the environment conducive to people moving there? And is the area growing? Like, are you seeing high population growth? And that's not like too difficult to determine. So if you look online and you look at like best places to move, you're going to find basically the best places to buy real estate, right? It's really not all that complicated. It kind of works that out for you. The next part is, cash flow is extremely important. So you want to make sure that you cover all your base expenses for the property, and then you need at least a little bit extra. So some things people don't really think about are like repairs end up costing a lot of money. If you're keeping the property for 20 to 30 years, you're looking at things like roofs, right, at some point, which is expensive. It's in like $10,000+. So you want to make sure that not only are you covering the cost of the property with like, paying the mortgage, insurance on the property or whatever else you have, but also unforeseen stuff like repairs and occupancy problems, right? So if you have like turnover, that's an unforeseen one. So you at least want your cash flow to kind of cover that. And then I prefer a little bit on top of that, right? So another big one I just thought was taxes, right? So taxes are a big one you have to think of as well. So you add all that stuff up, you figure out how much you have. You want to make sure you include things like the general rule for repairs is 1% to 2% of the property's value. And then occupancy rate, people generally do something like a 90 to 95 for long-term, 60 to 65 for short-term rentals. And then once you figure all that out, you want the end income to be higher than that. But yeah, that's about it.
Yeah, that's a great start for me. Thank you. The other thing I'm wondering too is when you make a down payment, what percentage do you do? And so I understand FHA loans will say you can do like 3.5%, and then I read some statistic recently. They said that typical new homeowners are doing 5%, and then typical second home buyers are doing 10%. But then I always hear that 20% is sort of the golden rule. What's your standard, assuming you have some flexibility in decisions? What's your go-to down payment?
Yeah, I mean, if you'd asked me this question maybe 10 years ago, it might have been a different answer because of the way the housing market was working. But so if you get a personal loan on a property you're moving into, you can get an FHA loan. And that means that the percentage, for your down payment can be significantly lower. It's down to 3.5%. But you could put in anything you want above that. That's totally fine. But you have to remember too that the lower percentage you go, the more that property is going to cost you per month. So that's a consideration. However, the reason it would have been different 10 years ago was that if you could cover like all the costs like we talked about in your first question with the least amount of down payment humanly possible, then your return on investment is significantly higher. For example, like if you put $100 down, I'm just going to use $100. Not that makes sense in properties, but if you put $100 down on a property and then you can cash flow $100 a year, your return on investment is 100% every year, right? Whereas if you put a down payment down of $10,000 and your returns every year are $200, yeah, your returns are higher, but your down payment was also significantly higher, so your return on investment is significantly lower. And what that means is like you want to put in as least amount of cash as possible, and you want to get back as much amount of cash as possible, and that ROI kind of there's like a balance somewhere, right? Mm-hmm. Where you put down enough down payment and you can get enough cash flow, and wherever that balance is kind of where you want to be. The reason I say that it's different today is because I don't know what the housing market's doing today, right? So yeah, I think that over the next 30 years it will be the same as it's always been, right? So for the long-term game, it's going to be the same as it's always been. But we're seeing declines now in the entire nation. So I did an episode a while back where I said like, San Jose, the Bay Area is declining, and people commented like, well, of course the Bay Area is declining. Those people are crazy, which is absolutely true. But now we're seeing declines over the whole country, and we're somewhere around between 5 and 10% decline. And I think that, the Federal Reserve just announced another 0.75% increase in interest rates, and they've said they're going to do this again. All right. And so I have a feeling that we're going to see some more declines. And if that's the case, you don't want to ever be upside down on your loan. You don't want to be in a position where you owe more on the property than the property is actually worth. Right. That's how Dave Ramsey got in trouble back in the late 70s when the housing market flipped on him. He owed way more than the values of the property. So if it's your first property and you're a little bit nervous about it, I would say that don't worry about ROI as much. Be maybe a little bit more on the conservative side. And, as you kind of figure this out, then maybe get a little bit more risky about it, right? Because the experience and the knowledge is going to change the risk factor for you, right? So right now the risk factor is high. You have no experience, no knowledge. You've never done this. You don't know what it looks like. So because of that, maybe a higher down payment. If I was to do it today, I would probably be putting down 25% on a property. Not because I think that the market's going to dip below that 25% marker, but because I said in the video I suspect it's going to be 15 to 20, and that gives me a buffer. And I could be totally wrong, and the worst case scenario is like, oh, I'm totally wrong, and whoops, I accidentally went too conservative, right? So yeah, I think right now I would go on the higher side. But sorry, I'm making this answer really long.
That was a good answer.
The other side too is if you are looking at personal stuff, as we started, like if you're looking to buy the property and move into it yourself, that changes some of the risk factor a little bit too, because you could stay in it longer and wait for the market to kind of flip, right? That's an option too. So like if you can put 3.5% down and you stay in it and it does dip below, well, as long as you're comfortable with, your emergency funds and your backups, your ability to produce income, that's not really as much of a risk. So if it was a personal property I'm moving into where I plan on turning it into an investment property later, then yeah, maybe I'd go lower. Maybe somewhere around 10, between 5 and 10 possibly. But that would be like, I'd have to know that I could stay in that property until the market, flipped and went the other direction.
That makes sense. Yeah, because the next question I was going to ask you is it better to live in or invest? I think you kind of answered that a little bit, or at least most of that. I don't know if you have anything more to add to that specifically.
Yeah.
I guess, some obvious things like living in it, you're more likely to be stuck there if something happens, for better or worse. And then, so I can think of some obvious ones. I don't know if you have anything else to add, or maybe you covered that all.
So yeah, so I think in this case, if you plan on turning it into an investment, that changes the scenario a little bit. But if you're just asking generally, like, is it better to live in a property or buy an investment property? I think that is based off of the cost of the property that you're purchasing compared to the rents in the area, right? So this gets a little complicated, and I plan on doing an episode about this because of how complicated it is. But for example, I live in a house in the Bay Area in California, right? And I rent this property, and I'm not, I'm not shy about saying that to people. And then I own property elsewhere, right? If I sat down and I did the math, the actual cost of owning this home, if you consider things like the down payment, the interest payments, the taxes, repairs, and everything, come out to be more than what it costs me to rent it. Right? So it's actually cheaper for me to rent it. And then people will say, yeah, but you're not getting the appreciation, except for that I am, because I'm using the difference and I'm purchasing houses elsewhere. Mm. Right? So I would say if the rents in the area you're looking at are actually cheaper than the cost, right? And I don't mean cost, like the principal payment, I don't count as cost, right? Mm. If you get a tax break because you're buying a property, that's not considered cost, right? That would be considered, like a bonus or like an asset when you're calculating that stuff down. But if the end cost compared to the end benefits of owning a house end up being more than rents, then I would suggest buying elsewhere. Okay. It means your area is not good.
That's a great tip. When you look for properties, like what's your procedure? Do you use like typical things like Zillow and those kind of websites, or do you? And I understand you're looking at rents and other factors and Google searches, but when it comes to the actual property itself, what's a procedure for looking at a property?
So finding one. I learned this the hard way, and I think that I lucked out super, super hard. I don't know, like if I'd have not figured this out, like so early on, if I would be successful in real estate. So I think this is a good question. The answer to that is people are 100% what you like your asset when looking for a property. So like we talked about before, like where you're gonna look for a property in terms of like where in the country. All right, so if it's in where you're living, that's always a huge, like if the area we're living is a good for like purchasing investment properties, then you're like the best off you can be, because you can go to stuff, you could travel around, you could talk to as many people as you want. If you're going elsewhere, the trick is going to be the people that are in that location. So the first is your real estate agent. Find a real estate agent that understands investment properties and has done this before. Like ask them if they own investment properties. Like, what do you own? Do you own short-term rentals, long-term rentals? How long have you been doing this? What's your success look like? What do you look for in properties? Ask those questions, because if it aligns with what you're doing, then they can do a lot of the legwork for you. Like, yeah, you can get on Zillow and you can find some stuff and you could toss it out there for them to take a look at. But if they have the same mindset you do, then the stuff that they find is going to match what you're looking for, right? So the first time I went down and I bought my first property, luckily I actually flew down and started looking around, right? My real estate agent wasn't all that great. The second time I started asking around to people I knew there, like who should I talk to? What's the real estate agent I should talk to? And I found someone who like really well aligns with what I'm trying to accomplish. The second part of that question is you're going to have to find somebody who like a general contractor who is really, really good, right? And that's tough. General contractors oftentimes will start projects and they'll ditch them. They'll dramatically overquote you on stuff. Like sometimes they're just not very good. Like they just actually don't know their craft very well, right? And there's a lot of that, and it's real difficult to find someone. But you want to find someone who you can trust, who will do the job with you not sitting there watching them do it, who will do the job well, who you can repeatedly call on. So my answer to that is like figure out where in the country you want to go, and then look for those two people. And do that before you actually purchase the property.